Ladies and gentlemen, we got Quincy Jones backstage, the highly respected software developer. I'm going to kick things off with a high stakes video. Thanks for tuning in, and thanks for joining us today, Quincy.
5, 4, 3, 2, 1, liftoff.
Hi, my name is Quincy. I'm a Solidity developer for the XDC Network.
Every XRP is made up of 1 million drops, and every transaction is 12 drops. And that's why I have a bot that does this automatically.
So you don't need an organization to facilitate these resources. Once you have access to the blockchain, you can access all the resources that people have been able to deploy there.
I actually don't value anything in dollars anymore. I either value it in XRP or I value it in gold.
Before I got into blockchain, I was actually a cloud developer, primarily focused on AWS, working at a private equity firm in the middle of converting their legacy system into the cloud that was primarily focusing on lending to small businesses and evaluating the credit and evaluating the cash flow of different businesses to be able to lend to.
The next securities markets or even NFT marketplaces are the exact same tools that are going to facilitate marketplaces for video games, facilitate marketplaces for different type of brokers all over the world and bankers, different marketplaces for carbon credits, whatever it may be. These are all fundamentally the same thing.
So all that clogged up piping in the financial system, from how slow money's moving around from bank to bank, institution to institution, merchant to merchant, merchant to bank, all these different moving parts will now be able to move up freely, quickly, and effectively with XRP, and not only between currencies, but between primarily derivatives.
People are able to engage in a way that they weren't able to before. They're able to utilize the technology to facilitate some level of communication or engagement in a manner that would otherwise be typically difficult or just simply wasn't possible.
You want to find potential. And I only say that because when I bring up the analogy with Apple, there are plenty of people that would say Apple's a dead company. It's dead. Who cares? That was back then. Now there are plenty of people that would be like, oh my God, Steve Jobs, yeah. But it wasn't obvious at the time. There's potential in the team, potential in the software, potential in the vision. And you need to start looking at that.
Hey everyone, if you're enjoying the content and find value in what I'm sharing, I'd greatly appreciate it if you like this video and subscribe to the channel. Your support not only helps this channel grow, but ensures that you stay up to date on the latest and greatest content. Thanks for tuning in today and for spreading the word. Love you mucho. Right on. Welcome back, ladies and gentlemen, to another much anticipated live stream. Today I have with me the one and only Quincy Jones, the much and highly respected software developer specializing in blockchain tech and currently building on the XDC network. With a background as an AWS Cloud Developer, Quincy's transitioned into a prominent public speaker, educating the audiences of the limitless possibilities for tokenization and blockchain integrations. Quincy first gained his recognition on the Matty G TV show. Fast forward to today, he's now here on my channel, and I'm super excited to have him here. Quincy Jones, how you doing today, sir? How's everything at the forefront of the digital transformation, and how's everything that you're working on driving transformation and innovation in blockchain sector, sir?
It's been great. It's been great. Lots been going on, a lot behind the scenes, but it's been really cool. Definitely seeing what's going on, not just at XDC, but all the different things that are going on in the crypto space, all the different developments, all the different new innovations. And it's kind of been like an honor sort of being in the middle of all of it. So yeah, definitely a lot of fun.
Yeah, absolutely. And all the drama as of late too. Jeez Louise, man. Anyways, hey, as the intro clip hopefully did some justice for all the achievements and accolades that you've accomplished in the short term. You had a background in private equity. Basically, you were well groomed for everything that's going on in this emerging landscape, because obviously this institutional grade blockchain infrastructure tap dances not just in finance but across many sectors as well. What are your thoughts on the future of finance and aka the finternet, according to the BIS? What are your thoughts on how this world is quickly moving towards being blockchain dependent?
Yeah, so I think what we're gonna end up seeing is, instead of people focusing on these face-to-face engagements in order to be able to conduct in trade, they can focus on conducting in trade over the internet. Now, a lot of people may go, well, how's that a lot different than what's going on now? Well, even now, when someone conducts trade using some online service, they have to go through a central party to do so. Someone's hosting that service, someone's running that business that's essentially allowing that service to operate, versus decentralized networks that are able to allow these services and applications to run autonomously. So you don't necessarily have to have someone in the middle in terms of being able to engage in the exchange between multiple parties. And I think that's the big thing right now. And it's funny, I speak to a lot of people on this. Right now, the majority of these different types of trades are made because of a face-to-face engagement or face-to-face connection, because there aren't very many technologies that allow for you to be able to expand your trade or your trade partner base without necessarily going to a central party or some sort of syndicate. So I think the future of finance is essentially going to be being able to take an already established trade pattern or an already established like behavior pattern and being able to engage with anybody on the internet with that type of trade rather than going through a particular intermediary to do so.
Interesting. A lot to unpack there. And, I was, before you hopping on here, I had the Uphold Institutional, they're having a webinar going on right now with the XDC Network as well. So I was picking up some of the jargon that Dr. Hiesbach was talking about and all that fun stuff, because
I love him. He's cool.
he really is. I was cracking up. I don't know if anybody else was, but the guy's humor is I think on point, especially for this industry. It's very dry at times.
Yeah.
But anyways, he mentioned, let me bring up onto the screen here. Give me one hot second. You guys are working on at the XDC Network or through the XDC tokenizing real world assets. And he goes, this is such a whitewashed term for crypto and yada, 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 just kind of unleashing for a hot second. What are your thoughts? You guys are doing, I had the opportunity of interviewing Sunil from the XCC Trade Network, and they just had tokenized the first promissory note, which is through the trade finance umbrella or industry. What's going on there? What's going on with XCC and real world assets tokenizing? Have you participated in the tokenization of any real world assets yet? Love to get more insights.
Yeah, actually, there's a huge push in terms of being able to take already established assets that exist in the real world, if you want to put it that way, and being able to bring them on chain into a DeFi environment. I sort of call it like from TradFi to DeFi. But the biggest thing is there are a bunch of services out there. There are a bunch of assets out there. And right now, there's sort of this hesitancy in terms of being able to move over to blockchain to be able to sort of reap the benefits. So one thing that we're doing here at the XCC Foundation is we're actively trying to assist different organizations in terms of them being able to not only come onto the chain, but also engage with other partners on chain. Because what's TradeFi without necessarily having TradeFi partners? So one of the biggest things that we're really trying to focus on is we have partners on chain that focus on very much a multitude of different tokenization methods, whether it's trade trust for tokenizing documents, whether it's trade finance or Trada in terms of being able to tokenize securities and trade those securities, whether it's USTY and being able to have US treasuries be able to back a stablecoin. These are all just different instruments that allow for more institutional organizations to be able to come on board and dive right into the ecosystem. Actually, sort of something that I've sort of been working on a little bit as well. Can't go too into detail, but we work with a client.
Let us spill the beans.
I can't spill the beans on what we do with different clientele, but we end up working with different businesses, and we see a multitude of different methods in terms of how we can be able to migrate them onto the public chain. One thing that we really try to focus on now is we try to allow them to set up a subnet or system in terms of being able to set up a subnet, and then allow them to take different accounting mechanisms and start converting them into Solidity applications or blockchain applications without them being fully exposed to the public network. And then when they start feeling more comfortable in terms of being able to expand the liquidity of the assets that are on that private network, they start moving it onto the main chain. And that's sort of something that we've been doing in terms of like a one-on-one with different businesses in terms of trying to get their toe into the water of crypto without them necessarily feeling, sort of, what is this? How do I do this? Is this safe? Is this secure? Am I able to have these different methods of maintaining PII data or private data? So there's sort of like this ongoing process of being able to introduce traditional institutions into blockchain. But it seems to be going quite well, actually. Once you really get past that first hurdle of what is blockchain, how do we use it, how do we integrate our traditional tech stacks into this, it just gets into, okay, great. Now that we essentially have this service, how can we expand the service to the widest amount of trade partners that we can? And that's sort of where we are right now in the space, is really trying to encourage traditional businesses to either utilize different services on XDC or being able to assist them in terms of being able to migrate their services onto the network as well, even if it's through a proxy like a subnet before they start bringing their assets onto the mainnet.
Do you see, with the, even going back to the intro video where you mentioned at East Denver when you're up on stage, that really all these networks are, if you were to strip them all down, they're really almost all this dependent on the same guts and systems. It's really what the community that interacts and engages with the systems that defines the utility for the tech. Or can you better articulate what you were trying to do, communicate?
Yeah. So a lot of people, this is like my favorite question. A lot of people ask, what makes this network better than or different than these networks, right? And everyone tries to come up with these ridiculous sort of propositions like, oh, our network has this software and our network has this thing and our network, and that's not really what makes the networks different. I usually like to use the metaphor of, well, what makes these social media applications different? TikTok is different from Instagram. Instagram's different from Twitter. Well, the thing that makes them different is how people engage with them. People go to Twitter to get a specific type of engagement. They're not going to go to TikTok to get a type of engagement they would get on Twitter. Same thing for Instagram. Same thing for Facebook. Same thing for or even the dating site like Tinder or something. People go to different types of platforms for a specific type of engagement. And it's the same thing when it comes to blockchain networks. So, and this is something that we really tried to emphasize because this is what we're seeing with a lot of these different networks. And when it comes to the software, the networks typically have a 70% overlap, at least the EVM ones do. But the biggest thing that really makes them different is how people are engaging with each other on that network. So one network could be for GameFi or cross-border remittances or TradFi or supply chain. The biggest thing is when you have this sort of ecosystem or this industry sort of engaging in this type of behavior, you're going to get a bunch of applications that are on that network to also engage in that type of behavior. I like to use VeChain as example for a supply chain application. Well, it's great if you are able to have one supply chain application, but it's also great if one supply chain application can engage with other supply chain applications. So then you end up going to that network for supply chain or XDC in terms of being able for TradeFi. If you want to be able to engage with more trade partners in a specific type of engagement, then you go to XDC. XRP for cross-border remittances. If there's a type of engagement for cross-border remittances, you're not going to go to VeChain for cross-border remittances. You'll go to XRP. So what's happening is you're starting to see a segregation in the behavioral, or at least in the activity around the behaviors on these different networks, and that's really what makes them different. Now I say that because when it comes to building applications on these networks, you in theory can build anything you want. You can build a social media application, you can build a trading application, you can build a marketplace, whatever. So what ends up happening is people just group to different networks to focus on the type of applications that people on that network are going to engage with. Like I said, if I wanted to build a supply chain application, I'd probably go to VeChain, or if I want to go into cross-border remittances, I'd probably go into XRP. But I'm not going to go into XDC if I'm trying to focus on some other type of activity that doesn't exist on this network. Now I say this because when a lot of businesses start evaluating different blockchains, they sort of see the same thing too. They're like, well, aren't they all technically sort of the same anyway? I don't see what the difference is. But then when they start seeing the different activities that are on different networks, they start going, yeah, it'd be a lot simpler for us to go to network A for this type of engagement than it is to go to network Z and then jump through a bunch of bridges just to get to network A or something. So you're starting to see them sort of differentiate the type of behaviors based off what networks have that environment.
While you're speaking, I just a light bulb. It's almost like, in a way, is each crypto its own machine learning AI system in a way? Or do you have to fine tune it and then it provides utility for that given community based on the inputs and data sets that have been groomed with?
I would put it as each network is almost like its own industry. That's a good way to put it. And within that industry, you have industry relevant applications. Now, I say this because I like to use the supply chain example, but there are other applications that assist stuff like that. So for trade finance, we see this with XDC. It's one thing to be able to engage in the trade of securities and equities and treasuries and stuff. But then there's an element of being able to verify documents as well before you're able to trade with them. So you may have applications that are focusing on the verification of documents that aren't directly focused on the trade, but you need those applications in order to conduct a trade. So what's going to happen is, or at least what I'm seeing is, each network is becoming sort of industry focused, and then you're going to see this conglomeration of applications focused on what's useful to that industry. And as you see more and more applications do that, each application can start engaging off of each other. So if I build a document validating application and somebody else builds a trade finance application, well, not only can I use their application to conduct trade finance, but they can use my application in terms of being able to verify documents and so on and so forth in terms of all the applications within that industry. So that's really what you're starting to see is industry specific applications, and then people basically flocking to those networks for whatever type of industry or whatever type of behavior that's unique on on that network.
Yeah, because when talking to Sunil, understanding that the XDC network in partnerships with Credor and other market participants, they're leveraging their systems, but working within the M-letter framework or the foundation of, or the standard of the documentation, how that information moves from one party to the next in respect to trade finance. And so then if you would say then XRP or other protocols are providing the tech that would then communicate those standards and allow basically a templatized swim lanes for those market participants to follow and abide by. Does that make sense? Or
Can you repeat that again? It cut out like a little bit halfway.
Yeah, absolutely. In a way, it's like we're still on the same subject here, where these blockchains or systems are adapted, or how can I say, they're leveraged to fulfill a need for the specific industry. Like, let's just say trade finance. Trade finance is dependent or leverages the standardization of M-letter. I believe it's the trade finance documents of how they're transmitted from one party to the next. And so because of that standardization of how those documents are moved, at least that creates a foundation or a practice or swim lanes for at least the developers to create this tech that says, hey, okay, well, if you guys are moving these documents, these trade finance documents from A to B, we can create a protocol that can do so in a encrypted manner, and then leverage the same type of system, but then for a different industry, which uses different practices, and then you tune or build the applications to abide by those standardizations, ISO, whatever they may be. Am I?
Yeah, so the best thing about standards, this is super great actually. The best thing about standards is, one, it gets everybody on the same page, but also it allows for everyone to be sort of interoperable with everyone else. We saw this in the early days of Ethereum, and we sort of see this on every network to some degree. But without any level of standards for anything, people start creating their own sort of standards, or they start creating their own practices, and it becomes incredibly difficult when you have 100 people with 100 different practices, and it's very difficult to be able to get them to all sort of get on the same page, all be able to engage with each other. But when it comes to different standards on network, whether it's like ISO standards or whether it's like Solidity, like SIP or EIP standards or whatever, what's really happening is you're starting to see a level of maturity come into the space where people now have an understanding of where they can move forward to. For the longest time, you could go, oh, let's get into crypto, let's build this crypto app. But then there's this element of, well, how will other people engage with it? Do they necessarily have the technology to engage with it? How do we necessarily know that they can essentially abide by the standard that we're putting out? Where being able to have sort of like these standardized practices can give people, as they're walking into the space, a sense of understanding on where they should go and how they should interact with other technologies. Because without that, usually what ends up happening is one or two projects will make it to the top and be really big, and then everybody abides by their standards. We saw this with NFTs and OpenSea. There weren't really any real standards around NFTs, and then OpenSea became the biggest like NFT marketplace, and now everyone just abides by whatever OpenSea does, even other marketplaces, right? So, and that's not necessarily a bad thing, but it'd be nicer for people to be able to come into the space and not necessarily have to abide by some arbitrary standard that some previous winner essentially set. And you start to do the same sort of issue in electric cars with like Tesla. Tesla created their own like charging standard, and then everybody else created a different charging standard. And now people without Teslas are like Can I go to these Tesla chargers? And people with Teslas are like, can I only go to Tesla chargers? You end up you end up with a situation like that. But because not everyone can create a car company, but everybody can create a smart contract, you get that on steroids, where everyone created a different type of plug and no one can necessarily plug into each other. But as you start seeing the space begin to progress and mature a bit more, you'll start seeing standards on a bunch of different types of stuff, whether it's tokens, whether it's trade standards, whether it's how different documents are verified or viewed. What the more you have, the more people have to work with.
Mm-hmm. Interesting. Thanks for the EV analogy, because that hit home. I deal with those pains all the time, especially on road trips that just meet the cusp of, can I make it there and back on one charge, and oh gosh, then you gotta then depend on whatever third party service, and it's usually one of those outlets are out right now. Talk about another nascent industry. That's one that's got a much growth potential. Speaking of growth potential, well, actually, before we get to there, I do want to talk about, you mentioned how you talked about XDC, Ethereum. I really like to, with your help, underscore the difference between XDC and Ethereum, understanding their XDC is built on EVM, and yeah, would love for you to explain the difference.
Yeah. So a little bit of the history on XDC. So originally, when sort of XDC was concocted by Zinfin, when it was back in 2017, I believe. Back when XDC was concocted, they were essentially originally using the Ethereum network, but the Ethereum network didn't necessarily have the performance, and essentially the costs were a little bit too much. So they decided to fork the Ethereum network and essentially create the XDC network. And the XDC network basically was there to quell a lot of the issues that Ethereum couldn't handle, whether that's speed and performance costs, but also it was a network in which they can now take a syndicate of different partners and now be able to engage directly with all of those different pluses on it. So in 2017, it was originally launched on Ethereum, but then the mainnet, XDC mainnet, was launched as its own private layer one, was launched in 2019. And then from there, we've been really trying to onboard different people onto the mainnet to be able to engage with the syndicate of trade partners that originally originated the network.
Mm. Got it. So are you guys aiming to then full circle work with some of the earliest parties that invested in Ethereum? Is that where you're getting at, or did I?
The biggest thing is now that there's a network that can allow for, so the whole premise was be able to use blockchain as a means to be able to expand trade. That was the key point. They went to Ethereum, didn't necessarily have the performance, launched their own network. Mm-hmm. Now that there is a layer one, XDC, the biggest priority around XDC is being able to make sure the network is able to facilitate the type of institutional trade that they originally were trying to do on Ethereum, but then also trying to onboard these institutions onto this network to engage with all these services that were originally placed on it. The original organizations that I think that operated on XDC was Zinfin, TradeFinex, and a few other just organizations that wanted to use blockchain but didn't necessarily have a place to go. Now it's expanded to a whole bunch of other organizations that have now onboarded onto the network, as well as new organizations that we're onboarding every day.
From the being a developer in the community, do you have any concerns with how Ethereum did its ICO when you see Ripple going through its jumping through its circus with the SEC on how its token was released, or is it a security, is it not? Was there any concerns about how this case or how it ends up and its impact on Ethereum or XDC and other tokens or protocols?
Yeah, so when people first started ICOing their coins or their crypto assets or whatever, there wasn't any term for anything outside of a security for what that was. It's like trying to create a new type of object, but then you have to sort of relate it in a way for people to understand. So you sort of have to rely on previous verbiage. Mm-hmm. Now, I think what ends up happening is I think there's a recognition that these crypto assets operate a lot differently than like traditional securities would typically operate. And the thing is yeah, they're used as a means for fundraising, but they're also used as a means to be able to deploy an initial set of capital into a network. I say this because there's almost no real effective way to do that. Like Bitcoin essentially had to be able the ability to mine the Bitcoin. That was one distribution method.
Mhm.
Um, but and you could go into what distribution method you seem is best or whatever. But the thing is in terms of being able to launch a network like this, you're going to need capital on the network. Otherwise, people aren't able to engage in all the different trade aspects that they'd like, or at least they wouldn't have the capital to.
Hmm.
Now, that doesn't mean there aren't networks that don't have tokens, like Hyperledger and Corda are some that don't necessarily emphasize their tokens too much. But there is a huge benefit in terms of being able to move capital on chain. And whether you like the ICOs or not, that was just a method of being able to bring capital on chain. Whether you want it to be through mining, whether you want it through an ICO, whether you want a mixture of both, where people can mine the network, but there was an ICO, whatever. I think these things are going to be recognized as something a lot different than a traditional like IPO or securities offering, just because of how the assets used, as opposed to how people would traditionally use a security. And I say that because it's not like people are using Tesla stock as a form of capital to create automated contracts and automated agreements and then forwarding the capital based off the agreement. Like people aren't doing that with traditional securities, but they are doing that with crypto assets. That's kind of the whole point of smart contracts. So I think there is something to be recognized in terms of the difference in how they should be looked at. But I do understand that at the time there wasn't any other term for this. So a lot of people sort of looked at this through this security lens. But I think that's going to change as the space matures more.
Yeah, absolutely. I mean, yeah, I saw a post from Matthew Rosendin, former VP of Ledger at Link2, had him on the channel last. He put out a post last week following our interview about how he created some new tokens that can create dividends on chain. Thoughts on what the future of security tokens look like, and the landscape, the involvement of broker dealers and market participants, maybe even if you'd be willing to discuss, is this only would those opportunities only be available to accredited investors?
So I think what's going to end up happening, and I see this a lot of people in crypto have this perspective in crypto through the lens of an individual, as opposed to the lens of like a firm of some sort. Now I say this because the biggest benefit that I see is you'll find like a firm with like some syndicate of this could be real estate, this could be whatever. They'll have a syndicate of partners. And traditionally, if they wanted to expand their partner base, they would just add to the syndicate. So every single time they add somebody, there's a whole new set of connections that they could have. What I'm seeing now is people bridging syndicates and taking the inventory they have and bridging them with other syndicates through the blockchain. So if I have my group of like 10 guys and you have your group of 10 guys, instead of trying to get 20 guys together in the room, we can just take each other's inventory and trade with each other over the main networks. And we can do that with 20, 30, 100 other syndicates as well. So we can expand our trade base of trade partners exponentially, without necessarily having to go through and make these relationships. And we can take the inventory we already have and be able to expand liquidity to other people who may want to trade with them without necessarily having to, like I said, engage with more brokers or more banks or more people to be able to allow this to be happen. A lot of it can be programmatic, which is part of one of the biggest benefits of this. But that's what I'm seeing in terms of how people use the software, because and this is something that sort of happens when crypto first came out, there was like the basic notion of sending a transaction. But as crypto starts to mature a bit more, there are levels of complexity placed on top of it. Now, this could be equity backed stable coins or smart contracts that trigger an escrow feature, whatever. These complexities typically tend to benefit some organization that's trying to expand their trade base. Whereas an individual may have an expanded element of their trade base through a debt, but that's not necessarily the exact same benefit of two syndicates being able to engage with each other over a public network.
Man, Quincy, there's so are you defining like what the XRP, or shoot, man, even what let's talk through the. I hate to bring up the company Polysign because I think it's left a stink in some people's taste buds as of late. But what Jack McDonald, the CEO of PolySign, who's now at Ripple for their stablecoin division, he would always talk about the atomic settlement protocol or atomic net being able to settle not just securities but many different assets. Is that what you're in essence describing as a protocol?
Yeah.
That can
Actually,
settle?
this goes into my second thing. Actually, so yeah, we like to talk about securities and treasuries and stuff, but you could actually look at it as any sort of asset or accounting mechanism that could otherwise be traded with any other party can be tokenized. So we don't necessarily have to be talking about stocks. We could be
Exactly.
talking about carbon
Swords
credits. We
or
could be
swords.
talking about inventory for a particular business. We could be talking about any type of unit of account that can be shared between two parties.
Or a skin on your character for a video game.
Yeah.
Am I wrong to say, because based on what you mentioned, if this asset or this technology can span across, gaming, finance, and others, it's basically the same tech.
Yeah. The biggest thing is it's shared accounting. That's the way I like to describe it. Traditionally, and I saw this back at the PE firm. Traditionally, you would have your technology stack, your database, your whatever. And if you wanted to trade with somebody else, they would have their technology stack, their database, their whatever. And then when you traded with each other, you both would need a copy of the transaction. You would both need the history of the previous asset you traded. And all of that's just a pain in the butt. It becomes relatively difficult, and you sort of have to have a personable relationship to be able to even get to that point. Where both of you instead can reference the blockchain as a shared database, and then you're just moving units of account within that database as you're both referencing at the same time. So instead of just having two separate databases or 100 different separate databases, everyone can reference the same database and be able to trade the assets that are on that. And yeah, anything that would otherwise be like, it could literally be anything. It could be an invoice, it could be an IOU. Anything that could essentially be traded between two people can essentially be tokenized.
I mean, and thanks for bringing up the IOU perspective, because ultimately, isn't that what everything is on chain, representing the underlying asset?
So you see that a lot, but that's not always the case.
Okay.
You see a lot of derivatives on chain where people just list like a paper asset as a token and trade it, and they're able to expand the total amount of liquidity that asset may have access to. But there are assets that are like native to particular chains. If you created a smart contract and that smart contract was lending out money, right? And then you tokenize that smart contract. So let's say it was lending out $1,000 and kept track of an interest rate. Well, you can tokenize that smart contract and you can sell the access to the interest or the access to the proceeds of the smart contract as a token. That token isn't a derivative, or at least that token is a derivative of the code in the smart contract that's facilitating the service. But there are a bunch of assets like that as well. So you can have assets that are a derivative of a traditional paper asset on chain, but you could also have native assets that are basically bound by whatever rules the smart contract abides them by, and those can also be tokenized as well. And what you end up seeing, at least with that, is people like to talk about like utility tokens or like token gating. Like I could create a token that acts as a key for you to log into something. That is a native token. It's not necessarily a derivative, or it could be considered a derivative of the application you're able to log into. But the means of where that token's origination place is on the blockchain. So you can't have assets that originate themselves on chain and can potentially do more than, I guess, sit around taking space in an account.
Yeah. I'm working with did you ever meet Boone Bergsma from Blockchain Labs? Yeah.
I have actually.
Yeah, working with him to build out some token gated features on a website to provide some interesting engagement activities and offerings to my community as we roll out my brand. Really exciting. Also, recently interviewed the CEO and co-founder of 2Ticks, which did the ticketing service for the XRP Las Vegas. So really interested and excited on the conversations around token gating and the future offerings that, I mean, even me and being able to engage with these services and tap into put my developer hat. I mean, I'm not doing any coding or anything, but to get into these environments and speak with developers like you that are extremely talented and decorated. It's always a learning lesson, but it's always exciting, and it's keeps me going. On the topic of I had the opportunity of interviewing at the XRP Las Vegas. So on the topic of XRP Las Vegas, you mentioned that crypto was in essence a talent pool, or a means of accessing a talent pool. What did you mean by that?
Um, So I don't think I said it's a means of accessing a talent pool. Usually when I bring that up, I usually
Yeah.
bring up that there isn't enough talent to be able to allow for the amount of adoption that people want.
Okay.
I say that because I saw that in cloud. So when I was working in like AWS Cloud Development, there was a huge problem where you would see a lot of new startups like spin up and they would use like cloud technology to do so. And then you would see these old businesses that are trying to migrate to cloud, but there weren't enough people that were either certified or had experience or whatever. And at the time, like cloud salaries were going through the roof. Like you could have been working in cloud for 2 years making six figures. Like it was just through the roof because there weren't anyone out there that had the skills. And that's exactly what we're seeing in crypto, where there's a shortage in the talent pool of people that can assist in the adoption, whether it's new startups or whether it's new businesses. And you can go, oh, would that mean that blockchain developers are going to make a ton of money? Probably. But the biggest thing is, in order to have adoption, you need people that essentially have the skills to be able to help migrate these new applications. And we're seeing more and more of it. Don't get me wrong, but it's very much an underrepresented pain point in adoption that doesn't necessarily get enough attention because everyone likes the new app that comes out. Everyone likes the new business that is on blockchain. You know, BlackRock's on blockchain now. But it's hard to be able to tell. And it's not just developers either. There's going to be people in finance as well. There are a lot of people who are very, very, very brilliant finance people that are like, I don't know what crypto is. No idea. I have no idea what it is. Don't care. And that's the thing. There needs to be people that are very much familiar with the space to be able to continue building in the space, regardless if it's the software or if it's just a standpoint of understanding what to do with the assets once they're on chain.
Yeah.
I say this because I spend a lot of my time explaining really basic stuff. Don't get me wrong, I explain a lot of things. But I find it really funny that the biggest question we get asked is like, what's the whole point of like blockchain? And the problem isn't that they don't know the point. The problem is there isn't enough people that have an understanding of the software to allow for that adoption to take place, or at least for it to come steaming in faster than we would otherwise like.
Well, and the reason why I have this photo taken of us from the on XDC conference, I believe was it in Austin or Dallas? Regardless,
Yeah, it was in Austin.
Austin. Okay, it was. I think it was last year, and it was these years just fly by. Can't believe I've been in crypto now for nearly 5. But where I'm getting at is, does it get you giddy when you see the likes of people like Andre Casterman or even Jay Claver that one have a very strong understanding for the financial space or sector and blockchain? I mean, Andre Casterman formerly worked for Swift as an executive. So when you see someone at the helm of Swift engaging in the XDC network, how does that make you feel?
It's definitely like a cool feeling. I think the biggest benefits is, um, so there's this like phenomena. I see this with software developers, and it doesn't exist. It may exist outside of it, but I don't see it as much. It's one thing for a software developer or some founder to give you some high in the sky pie idea of like some future application that doesn't exist yet. But when you have real people that come from like the traditional like finance sector, come from traditional businesses, not only being able to take their experience and being able to elaborate on that, but also being able to like correlate the things that they see valuable on crypto and how they can essentially migrate into the traditional space. I think it's exactly what we need to get more people to have an understanding of what blockchain is about. And like I say this all the time because there's no shortage of like hippy dippy founders saying we created the blockchain to cure cancer, right? Some crazy high in the pie, silly idea. But you don't have enough people that are saying, hey, I work in finance and I did X, and we could do more of X if we use this software to do it. You know what I mean? It's a lot more grounded of a conversation. People that aren't in crypto don't even need to like worry about the crypto component. They're more focused on, oh, you're telling me my business can save money? How's that, right? And it sort of already opens up the door to allow people to be a lot more open to these applications and a lot more open to these networks.
What do you see as you mentioned the understanding or the educational component around this growing yet nascent industry? What are some other large hurdles that you're facing that you think that you would be keen on reaching out to a community member for support? Let's just say if you had the likes of somebody of an Andre Casterman that's tuning in today, what would be something that you would be reaching out for support, if any?
Like, I guess the biggest thing that I think would need to be sort of emphasized, at least for somebody that isn't crypto native but interested, is funny enough, as someone who's into the software, it's not about the software like at all. Um, it's about how you can essentially create a more efficient system and how you can essentially allow for people to be more open to utilize like it sounds, because I don't want to make it seem like, oh, if they just use the software. No, it's there's an understanding on what can be done with a certain thing, and that's why I sort of emphasize the finance guys is you need to have that understanding before you can justify how you do it, right? So I can say, oh, use crypto, use crypto, use crypto, but you have to have a fundamental understanding of what they were using beforehand and then be able to convey what makes this better about it. You see what I mean? It's not just, oh, use the crypto, use the software, use the token of, instant settlement. That's all great, but it has to be through the lens of, oh, this is how we do business this way. This is how you can do business this other way. If we're able to close that gap, we can be incredibly more competitive. And that's the conversation we need to be having, not like, oh, this token's amazing, or this token can do this, or whatever. It's to what degree can I get a better level of efficiency for my product, my service, my whatever? And is this a way to go about it? Now I say that because here's the problem. People go about it the opposite end. They go, choose my network because X. And well, one, it ends up like sort of like morphing people's brains because it becomes this idea of like, oh, do I use this network versus this network, which is kind of irrelevant to a lot of these businesses. It's just more of an understanding of if I do use this, to what capacity is this going to help me? And to what capacity can I use this to help my trade partners or whoever I'm working with?
Yeah.
Once you have that conversation, then you can get into the technical details about whatever you want to do and how you want to do it and to what capacity you want to build it and all that.
That makes sense. Understanding your landscape in order to optimize leveraging blockchain, AI, or any other type of a tech-enabled platform or utility. Switching gears here, and we've got 15 minutes, Quincy, so I'm going to start winding things down just because I've got a hard stop supporting Jason Cousins, CEO of Glint, and Miles Franklin founder, Andy Scheckman, for the episode 6 production of the podcast, the resilient compass. Yeah. So I got to jam over there. Actually, I'll be sitting right here, but I got to hop to a next screen.
Yeah, you got to hop over.
But anyways, but before you go, I do have some pressing questions and hopefully the audience will appreciate actually, we'll get to this. Why did you, and it's about the XRP drops, but before we get to the XRP drops, why did you choose R3 Corda when first getting into the space, as I believe was it your first employer in the sector in blockchain?
No, I was working at the PE firm at the time.
Okay.
But here's the story on that. So so I guess you could say like private equity in Arizona is like a small crowd. So we would spend like 70% of our business sort of focusing on lending to small businesses. And then another 30% of our business was basically going out and reaching out to startups. We'd go to the university, we'd go to different organizations like Venture Devils, Coplex, and we would just see startups, right? I was in the startup game. I've had my own fair little bit of startups and stuff, and we were in the startup game. And then around 2018 or something, crypto became the big thing, and everyone and their mother was launching a crypto application. So there was this idea of like, okay, what's crypto? What's the point? What are we doing this for? Blah, blah, blah. We started looking into Bitcoin, Ethereum, the tokens and stuff. And we ended up latching onto a really interesting idea of, well, there's this idea that we can essentially automate the moving of capital, but also automate a lot of these different components in how we move that capital. And we're like, that is a very interesting idea. So how can we do it? And eventually we were sort of like focusing on like Ethereum and some other technologies. But there was a big but. The but was you kind of lose all the benefits of using blockchain as a means to move capital if the volatility makes your business like not viable, right? Like, how am I supposed to accept $100 and then it's worth $80 and then it's worth 150, then it's worth 20, and it's like how are you supposed to essentially like conduct business in that way?
How are you supposed
So
to
we were looking
sleep?
at a bunch. Yeah, right. So we're looking at a lot of different technologies in terms of like, is there a way we can use the technology without necessarily focusing so much on the volatility of the token? And we ended up looking at Hyperledger and Corda. Now we ended up settling on Corda primarily because I think Corda was just better documented. But Corda wasn't necessarily emphasizing or focusing around a token at the time. So there was this idea of, and we were using AWS at the time. So there was a lot of documentation on how you can use Corda and set up Corda nodes and AWS, all this stuff, right?
Mhm.
Just it fit so nicely into what we were already doing. So the biggest thing we started doing was, can we set up different Corda nodes and can we build core dApps? And part of the reason we really like Corda too was Corda Settler. Corda has a mechanism that allows you to track off-chain payments within your Corda ecosystem. So if we did want to work with somebody outside of the Corda ecosystem or whatever, we can essentially utilize that tool to be able to engage and be able to keep track of these off-chain payments. So we ended up sort of settling on Corda for a bit. I spent almost like a year just studying not just Corda, but like Bitcoin, Ethereum, the EVM, a bunch of stuff. And yeah, that was just sort of like my intro into crypto. It was just sort of this mindset of how can we build this? How can we take what we're doing now? This is what I talk about all the time. But how can we take what we're doing now and essentially move it onto blockchain to allow it to be one, faster, cheaper, but also a level of automation that we weren't already getting. And I say that because our whole business was like, and the thing is, when we lent to small businesses, we would actually be working with vendors. So the small business would actually go to this website and like order some machinery or something, but then they would need to get financing for it. So the whole process would be like they go to this website, they file this application for like a couple $1,000s to buy this machine. Someone at the office would get the application. They would go, well, first they would like double check some like credit stuff just to see if it's like worth engaging with. But then they would go, okay, maybe it's worth engaging in. They'd call up the underwriter, see if the underwriter would approve. They would call up the vendor, see if the vendor would approve. And it'd be a whole process. Like, and we were already in the middle of automating that. It would take about a week for one deal to go through. We were trying to get it down to 24 hours. But then we were like, is there a way that you can use blockchain to where the underwriter can release the funds programmatically? The vendor can essentially have a token that represents the thing that's being bought. Is there a way that we could essentially have this like one smooth motion rather than a series of steps that at the time was almost fully manual, but became more progressively automated as we started building it out? And that was just sort of like my intro into crypto, is like, how can we essentially solve this particular problem using this particular software and going through the motions in terms of how to do that.
Yeah. So top of mind for you was automation, interoperability, and and ease of use, dependent on the industry or specifically trade finance. We've got 9 minutes here, Quincy. So I wanted, and before we close things down, I do want to play an outro video. So just want to be mindful of that. But quick question before you do go, or we do wind things down. What is going on in regards to XRP drops? What would trigger that utility function, or being, I guess, on a larger scale? Because I believe for every transaction it uses 12 drops, and if there's hundreds of thousands of transactions, you're still only talking about the burn rate of 1 XRP. So XRP, for those in the audience, is a deflationary asset and compared to others. But what do you think is really going to underscore the utility function for XRP drops?
So the drops are really more about the type of spread you could have for finance applications on the network. So one of the biggest things I like to emphasize on that was, at the time I was sort of like looking into like, oh God, arbitrage and a bunch of other stuff. Like I said, I was in the finance bro era, or finance bro arc of my life, right? Like everyone there, they're all finance guys, all finance grads. So I was like really big into arbitrage at the time. And the biggest problem with arbitrage isn't like, arbitrage is really easy actually, but the problem is each exchange you go to has its own spread, and it's really difficult to be able to predictably find like opportunities to arbitrage when doing that. But then when I was looking into different blockchain technologies, especially like XRP and even just some of the other ones with like cheaper fees, you can arbitrage between two dexes with a spread of 12 drops, right? Or I mean, I guess technically on XRP, since the XRP ledger is the DEX, you could arbitrage between multiple assets, and the spread is like 12 drops. Or on XDC, for instance, if you want to go between multiple DEXs, the spread is just like this tiny transaction fee. So, and the spread is consistent. That's the beautiful part. So if I'm going between multiple parties, multiple assets, multiple whatever, it's still 12 drops, not 2% over here, 1.5% over here, 3% over here, whatever. It was just 12 drops across the board, which made it a lot more predictable in trying to find different like arbitrage opportunities. But also it sort of opened up this idea of like, why go between different exchanges? And there's a whole other sort of theory behind that because of how XRP works. But is there a way to sort of like take advantage of the is there a way to take advantage of the price differences? And even though the transaction, because you make less money on the transaction, but it's almost guaranteed because the spread is so small. So instead of making like 1%, you're really making like 25 basis points. But the 25 basis points is always there because there's no exchange putting their spread on top of it. You see what I mean? Or putting whatever fee on top of it.
With the whole yen carry trade that recently occurred, in a way, is that do you think that relates or is relative with just in the respect to the global or macro markets? Is that with the whole I guess you would say the what's the word I'm looking for? The breakdown of the markets because of in response to the yen carry trade, which was due to arbitrage opportunities. Do you think that by having all of these markets potentially on one ledger, that would avoid the, I guess, breakdown of the markets or improve the integrity of the global financial system?
I think you'll see less volatility across the board, primarily because right now the biggest thing is each organization sort of has like their own amount of activity that's sort of determining the price. Where if you're able to operate on chain, everyone is sort of operating at that universal standard in terms of being able to engage with each other. So you don't necessarily have these pockets with these different differential in prices or differential in whatever, right? So I think what's going to end up happening is you'll end up with less volatility and a bit more consistency in the trade. You'll obviously have more liquidity as well, considering you're able to trade with everyone and not just some small group of people over here. But I think that's the biggest thing is just more liquidity, less volatility, and obviously faster trade because there's instant settlements.
Yeah. Well, Quincy, there has been a lot that we didn't discuss. I've sent you a brief with nearly 100 questions, but so maybe I could have you back for a follow up. One thing I did want to mention while I did have you here, I'm discussing on let's see here. I'm trying to get to, or I will be having up here soon. Excuse me. Here we go. Share screen. Let me bring this up to here. Descent cold storage wallets. You mentioned that there's so many concerns with navigating the marketplace. Even my mom, I had a recent conversation with her because I'm, as mentioned, working with Boone Bergsma to build up my own platform, leveraging token gating systems. Well, that has a Zaman wallet plugin or integration, and my mom doesn't have a cold store or doesn't have a Zaman wallet because it's connected to the internet. It's a hot wallet, and so there's just a lot of things that nuances to navigate in the marketplace depending on what you're trying to achieve and comfortability. There's a lot of things to be mindful of. I had the opportunity of interviewing the head of global markets and sales. His name was Wanku Kim. I met him at the XDC conference as well. I'll be having him back on I'll be having him on the channel, I'd say at the end of this month or in the next couple of weeks here. He's going to be at Token 2049. What are your thoughts before we let you go? What in 1 minute, if you don't mind, give me favorite cold storage wallet or what you look for in a cold storage wallet and why?
Yeah, I guess for me, I've literally tried all of them, literally all of them. For me, the best thing about a cold storage, they're all the same. So you have to remember that. The best thing is convenience. I actually really like Decent because of the fingerprint scanner.
Yep.
Super, like, I'm surprised more of them don't have that.
Yeah.
Most of them sort of have like extra ways, like you're putting in like a pin or a password or a thingy. Fingerprint scanner super nice. Just done, done,
Yeah.
done, 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 done.
Yeah.
I like that a lot. There are some other ones that I think are pretty cool. Like Arculus is a cool one. They have like a little card. I know there's another one that's like that as well. Tangent's like that.
Tangent. Yeah.
Yeah, where you have a card. Those are really nice. Very convenient. Very convenient. You could be out. Like I think I have it right here actually.
Yeah.
Yeah, look at that. So you can be out. You can tap the card. You're done.
Oh.
But the biggest thing you really want to focus on is convenience. A lot of people seem to think that like, oh my God, if I get the most inconvenient storage wallet, it must be also hard for the
Yeah.
hackers. And it's like the hackers aren't going to get you like that. The hackers are going to get you through like some spoofed email pretending to be somebody and hope that you're stupid enough to send them the keywords.
Yeah.
You know what I mean?
Yeah. The reason why I asked is because I just got even my Ledger stacks in the mail after waiting 3 years. It's sitting right here, but
Oh goodness.
I'll be making a video on that one. But hey, I'd love to have you back sooner rather than later, if you don't mind. I do need to close this down. Hop to my next endeavor here. But it was great to chat with you, Quincy. Love to talk more about the projects that you're working on that are coming across your table, especially in regards to the real world asset tokenization. I think in specifically real estate, because that seems to be booming or on the top of everyone's mind. But regardless, thanks for joining us today. I hope everybody, if they've got any other questions for Quincy, to leave those in the description below. But Quincy, appreciate you. I'm going to close this down, and I'll shoot you a text, and I'll bug you later. But it was great to have you today, sir, and I hope you have a great rest of your Taco Tuesday.
Great being here. Thank you so much.
Hey,
you too.
All right, see you, sir.
The banks tell you to put your money in the bank and save it. But you put your money in the bank for them to buy assets, for them to get rich off of, just for your money to lose its value so they can pay you back with cheaper dollars. You don't want to necessarily call it exactly a scam. You get the shortest end of the stick. And that's the thing, I'm not a gold guy. I'm not here to go, oh, everybody better get in gold. That's the only real money. But I do understand the functional utility of a financial instrument that can measure wealth. And gold does that really well.